Before we dive in, a quick but important heads up. I am not a licensed financial advisor or insurance agent. This video is for educational and informational purposes only. The goal here is to demystify a complex process, but you should always consult with a qualified professional for advice tailored to your specific situation. Think of this as your battle plan, not as legal or financial counsel. Okay, let's talk about that piece of mail. You know the one. It arrives like clockwork, either in your physical mailbox or as a sterile, unassuming email. It's from your car insurance company. You open it, maybe with a little sigh, and your eyes scan for one number, the new premium. And that's when your stomach does that little flip. It went up. Again. Maybe it was a small jump, just enough to be annoying. Maybe it was a huge leap that makes you question your budget for the next 6 months. But the most frustrating part? You haven't done anything wrong. No speeding tickets. No accidents. No new teenage driver in the house. Your car is a year older, it's worth less, yet somehow you're being asked to pay more. So you do what most of us do. You grumble, you might complain to your spouse, and then you pay it. Because what other choice is there? Feels inevitable. Unavoidable. A cost of living like death and taxes. Well, I'm here to tell you that feeling of helplessness is not an accident. It is a multi-billion-dollar business strategy. Your car insurance company is banking on your confusion, your busy schedule, and your belief that this is just how it works. They are counting on you to do nothing. And for millions of Americans, that bet pays off for them year after year. Here's a staggering fact. A recent study found that loyal customers, people who stick with the same insurer for years, often pay significantly more than new customers for the exact same coverage. It's called a loyalty tax. It's a penalty for being a good, reliable customer. It feels backwards, it feels unfair, and that's because it is. You are being systematically overcharged because it's easier and more profitable for them than earning your business every year. But that ends today. This isn't just another video explaining boring insurance terms. This is a masterclass in taking back control. Over the next several parts, we are going to pull back the curtain on the entire car insurance renewal process in the United States. I am going to arm you with the knowledge, the strategies, and the exact language you need to turn this frustrating, expensive chore into a simple, empowering process that can save you hundreds, if not thousands of dollars every single year. We will dismantle the myth that your renewal is just a bill you have to pay. It's not. A renewal is a new contract offer. That's it. It's your current company saying, hey, based on our new calculations, here's what we're willing to charge you for the next 6 or 12 months. Take it or leave it. And for too long, we've been conditioned to just take it. We're going to teach you how to negotiate, how to shop smart, and how to make them fight for your business, not the other way around. So, what's really going on when that premium mysteriously creeps up? It's a perfect storm of factors. First, there's inflation. Yes, the cost to repair cars, from bumpers to advanced sensors, is going up. Medical costs for injuries are rising. Insurance companies aren't wrong about that. But where it gets murky is how they pass those costs on to you. They don't do it evenly. They use incredibly complex algorithms to figure out who is least likely to shop around, who is least likely to complain. They profile you based on your credit, your zip code, your history with them, and they essentially make a calculated guess. How much can we raise this person's rate before they finally leave? This practice is called price optimization, and while some states have cracked down on it, it's a core part of the industry's playbook. They are squeezing the maximum possible profit out of their most loyal customers. Think about your cell phone provider or your cable company. They constantly offer incredible deals to new customers, right? A free phone, a massive discount for the first year. But what do they offer their long-term loyal customers? Not much. The car insurance industry operates on the exact same model. They spend a fortune on advertising to lure you in with a low introductory rate, and then, slowly, renewal by renewal, they turn up the heat, hoping you won't notice the water is starting to boil. The entire system is designed to be confusing. They send you a 20-page document filled with terms like bodily injury liability, comprehensive deductible, uninsured motorist coverage, and PIP. It's an alphabet soup of jargon designed to overwhelm you into submission. You look at it, your eyes glaze over, and you think, I don't have time for this. I'll just pay it. That is the reaction they want. That is the reaction they profit from. But what if you understood what every single one of those terms meant? What if you knew exactly which coverages you needed for your specific situation and which ones you were overpaying for? What if you knew the 3 key numbers on your policy that determine 80% of your premium? Suddenly, that 20-page document isn't an intimidating monster. It's a simple price list. It's a menu. And you are the customer in charge of what you order. That's the power we're going to give you. We're going to start by breaking down the anatomy of your renewal notice. We'll go line by line through that declaration page, translating the jargon into plain English. You will learn the difference between liability and collision, why your deductible is so important, and how a small tweak to your coverage could save you a fortune without putting you at risk. We will then move into the action phase. We'll cover the exact timeline of what you should be doing 60, 45, and 30 days before your policy renews. No more last-minute scrambling. We're going to create a simple, repeatable system. This includes the secret to getting truly comparable quotes from other companies. Most people do this wrong. They just plug their info into a website and get a dozen different quotes with a dozen different coverage levels, making it impossible to actually compare apples to apples. We'll show you how to get an apples-to-apples quote every single time, so you know for sure if you're getting a better deal. And finally, we'll get to the most powerful part, the negotiation. We'll give you word-for-word scripts you can use when you call your current insurance company. You'll learn how to calmly and confidently present your competing offers. Ask for specific discounts you're probably entitled to but aren't receiving, and make it clear that you are a savvy, informed customer who won't be taken for a ride. You will be shocked at how quickly their tone changes when they realize you've done your homework, and you're not just going to roll over and accept their first offer. This knowledge is more critical now than ever before. With costs for everything rising, finding an extra $300, $400, or even $800 in your budget can be a game changer. That's a car payment. That's a family vacation. That's a significant boost to your savings. And it's sitting right there, hidden in the complexity of your car insurance renewal. It's time to claim it. So let's get started. Let's decode your renewal and put you back in the driver's seat of your finances. The journey begins with a single piece of paper, or more likely these days, a single email. It arrives unceremoniously, maybe a month before your current policy is set to expire. It's your car insurance renewal notice. For most people, this is a moment of mild anxiety. You open it, your eyes scan for one number and one number only: the new premium. You see it, you grimace, you sigh, and you probably tell yourself, well, I guess that's just what it costs now. Then you file it away, set up the automatic payment, and forget about it for another 6 or 12 months. This is the cycle. This is the trap. And today we're breaking it. That document isn't just a bill. It's a report card. It's a story about the last 6 months, and it's a contract for the next 6. Ignoring the details is like signing a legal document without reading the fine print. And trust me, the fine print is where they get you. So grab your latest renewal notice. If you don't have it, pull it up on your insurer's website. We're going to dissect this thing line by line and turn that confusion into pure cold hard cash savings. The first page you'll likely see is called the declarations page. Think of this as the ID card for your car insurance policy. It lists the absolute fundamentals: who you are, what cars are covered, who the drivers are in your household, and the policy period. That's the start and end date of your coverage, usually a 6-month or 1-year term. Right away, you need to play detective. Is everything on this page 100% accurate? Is your address correct? Did you sell that old Honda but it's still listed? Is your son who moved out 3 years ago still on your policy as a primary driver? Every single line item here is a potential variable in your pricing equation. An incorrect garage address, even by a few zip codes, can cost you hundreds. A driver who no longer uses your vehicle can be a massive drain on your premium. Verify everything. This is your first, easiest chance to spot a costly error. Now let's get to the heart of the document, the coverages. This is where the jargon monster lives, and it's what scares most people into just paying the bill. But we're not scared. We're going to translate it. You'll see a section, often laid out like a menu, with different types of coverage followed by numbers. The most important ones are liability, collision, and comprehensive. Let's start with liability. This is the one coverage that is legally required in nearly every state. Liability coverage is not for you. It's for everyone else. It pays for the damage you might cause to other people and their property if you're at fault in an accident. It's broken down into 2 parts: bodily injury and property damage. You'll see numbers that look something like 50/100/25. This isn't a secret code. It's shorthand for your coverage limits, in thousands of dollars. The first number, 50, means your policy will pay up to $50,000 for injuries to a single person in an accident you cause. The second number, 100, is the maximum your policy will pay for all injuries combined in that single accident. So if you hit a car with 3 people in it, your insurance will pay out a total maximum of $100,000 for their medical bills. The final number, 25, is for property damage. This means your insurer will pay up to $25,000 to repair or replace the other person's car, or anything else you might have damaged, like a fence or a mailbox. Here's the critical takeaway for liability. State minimums are dangerously low. Many states only require something like 25/50/10. In today's world, with the rising cost of cars and healthcare, a $25,000 limit for property damage won't even cover the cost of a new Toyota Camry. If you cause an accident that results in more damage than your limits cover, guess who's on the hook for the rest? You are. They can come after your savings, your assets, even your future wages. This is one area where trying to save a few bucks a month can cost you everything you own. Look at your liability limits on that renewal. If they're at the state minimum, you need to seriously consider raising them. The cost to increase your liability coverage is often surprisingly small, but the peace of mind it provides is immeasurable. Next up are the twin coverages that actually protect your car: collision and comprehensive. They're almost always sold together, and if you have a loan or a lease on your car, your lender requires them. Collision is exactly what it sounds like. It pays to repair your car if you collide with another object, another car, a pole, a guardrail. It doesn't matter who is at fault. If your car is damaged in a collision, this is the coverage that fixes it. Comprehensive is for almost everything else. Think of it as acts of God or bad luck insurance. A tree branch falls on your car during a storm. A deer jumps out in front of you on a country road. Your car gets stolen. A rock cracks your windshield on the highway. Hail damage. Vandalism. All of these are typically covered under comprehensive. Now, tied to both collision and comprehensive is another crucial term: your deductible. The deductible is the amount of money you have to pay out of your own pocket for a claim before the insurance company starts paying. So, if you have a $1,000 deductible and you get into an accident that causes $5,000 of damage to your car, you pay the first $1,000, and your insurer pays the remaining $4,000. This is where you have direct control. The deductible and the premium have an inverse relationship. If you want a lower monthly premium, you can choose a higher deductible. If you want to pay less out of pocket after an accident, you'll choose a lower deductible, but your monthly premium will be higher. Look at your renewal notice. What's your deductible? Is it $500? $1,000? $2,000? Ask yourself this honest question. If I got into an accident tomorrow, could I comfortably write a check for that deductible amount without causing a financial crisis? If the answer is no, your deductible might be too high, even if it's saving you money each month. But if you have a healthy emergency fund, raising your deductible from, say, $500 to $1,000 can result in significant savings on your premium, year after year. It's a calculated risk, but one that can pay off handsomely if you're a safe driver. Finally, you'll see the premium breakdown. The bill itself. It might be listed as a 6-month total or a monthly payment. And here is the most important part of this entire exercise. Do not just look at the new number. Find last year's or last term's renewal notice and compare them side by side. Did it go up? By how much? 5%? 15%? This is the number that tells the real story. An insurer raising your rates is telling you something. They're saying that, based on their data, you have become a bigger risk. But why? Did you get a speeding ticket? Were you in an accident? If the answer is no, then you have to ask the hard questions. If your driving record is clean, your car is a year older, and you haven't made any claims, why on earth should you be paying more? The truth is, it might have nothing to do with you at all. It could be inflation, an increase in accidents in your zip code, or simply the company trying to boost its profits. They are counting on you not to notice, or not to care enough to do anything about it. They are counting on your inertia. And here's a dirty little secret of the renewal process. Sometimes it's not just the price that changes. Insurance companies can and do alter your policy at renewal. They might change the terms of your rental car reimbursement, reduce a specific coverage limit, or add a new exclusion you're not aware of. It will all be buried deep in the dozens of pages of legal documents they send you. Documents that 99% of people never read. They're hoping you only look at the price on the first page, because a change that saves them money might be hidden on page 27. That's why you have to look. You have to compare the old policy to the new one, not just the price tag. So now you have the tools to read that renewal notice. You can translate the jargon, you can understand the coverages, and you know what to look for. You've moved from being a passive victim of the price to an active investigator of the policy. You can see where your money is going, and you can spot the red flags. But understanding what changed is only the first step. The real power comes from understanding why. Why did your rate really go up? The answer often lies in a complex system of data points and hidden risk calculations. A driver score that you've probably never even heard of, but which dictates the price you pay. It's a number that judges your every move, and in the next part we're going to pull back the curtain and show you exactly what it is, how it's calculated, and how you can take control of it. This number, this secret score, is officially called a credit-based insurance score. And no, it is not the same thing as your FICO score or the credit score you see on your banking app. But it is built from the exact same raw material, your credit report. For decades, insurance companies have been quietly using a modified version of your financial history to predict a very specific outcome: how likely you are to file a claim. Their logic, backed by mountains of actuarial data, is that how you manage your money is a powerful predictor of how you manage risk in other parts of your life, including behind the wheel. It sounds crazy, right? What does a late credit card payment have to do with you stopping at a red light? To the insurance company, it's all about correlation. It's a story of patterns. Imagine two people, let's call them Alex and Ben. They live next door to each other in identical houses. They drive the exact same model of car, a 2022 Honda Civic. They have the same job, are the same age, and have perfectly clean driving records. Not a single ticket or accident between them. On paper, they are the same driver. Their insurance premium should be identical, but it's not. Alex pays $300 less every 6 months. Why? Because Alex has a long history of paying bills on time, keeps low balances on his 2 credit cards, and hasn't applied for new credit in 3 years. Ben, on the other hand, recently lost his job. He's been late on a few payments, his credit cards are nearly maxed out to cover expenses, and he just applied for a new store card to buy a washer when his old one broke. Even though Ben has never caused an accident in his life, the insurance company's algorithm flags him as a higher risk. The data suggests that individuals under financial stress are statistically more likely to file claims, not necessarily because they drive worse, but because they might be more inclined to file a small claim they would otherwise pay out of pocket, or they might be less focused on the road due to stress. The insurer isn't judging Ben's character. It's just playing the odds based on a pattern observed over millions of other people. Alex is seen as stable, predictable, and low risk. Ben is seen as volatile, unpredictable, and high risk. And that difference is reflected in cold, hard cash at renewal time. So what exactly are they looking at when they build this secret score? It's not a one-to-one copy of your credit score, but the ingredients are similar. The most heavily weighted factor by far is your payment history. This accounts for a huge chunk of the score. A long history of on-time payments tells the insurer you're reliable and responsible. Late payments, accounts sent to collections, or a bankruptcy can be devastating. It's the financial equivalent of a major at-fault accident on your driving record. The second biggest piece of the puzzle is what's called your credit utilization ratio. This is a fancy term for how much of your available credit you're actually using. If you have a credit card with a $10,000 limit and you have a $9,000 balance, your utilization is 90%. To an insurer, that's a massive red flag. It suggests you're stretched thin financially. Someone with the same $10,000 limit, but only a $1,000 balance is seen as a much safer bet. Most experts recommend keeping your overall utilization below 30%. Next, they look at the length of your credit history. The longer you've had credit accounts open and managed them well, the better. A lengthy history provides more data points, painting a picture of long-term stability. This is why closing your oldest credit card, even if you don't use it, can sometimes hurt your score. You're essentially erasing your longest track record of good behavior. They also scrutinize your pursuit of new credit. If you suddenly apply for 5 new credit cards and a personal loan in the span of 2 months, the algorithm gets nervous. It can signal that you're in financial trouble and desperately seeking funds. Each of these applications creates what's called a hard inquiry on your report, and too many in a short period will temporarily lower your score. Finally, they consider your credit mix. The system tends to reward people who can successfully manage different types of debt, like a mortgage, an auto loan, and a couple of credit cards. It shows you can handle various financial responsibilities. Now, this entire practice is incredibly controversial. Critics argue that it's fundamentally unfair. It can penalize people for circumstances beyond their control, like a medical emergency that leads to huge debt, a divorce, or a layoff. It essentially punishes people for being poor or for having bad luck, equating financial hardship with being a bad driver. The system can create a downward spiral. You lose your job, your credit suffers, so your car insurance goes up, making it even harder to get back on your feet. Because of these arguments, a few states have taken action. California, Hawaii, and Massachusetts have banned the use of credit information in setting car insurance rates. Michigan has also placed heavy restrictions on it. But for the vast majority of Americans, this secret score is a powerful, invisible force affecting their premiums. So, knowing this, how do you fight back? How do you take control of this number that's judging you from the shadows? The power you have is that this score is not permanent. You can absolutely change it. The first step is to see what the insurers see. You are legally entitled to one free credit report every year from each of the 3 major bureaus: Equifax, Experian, and TransUnion. Go to the official government-mandated site, annualcreditreport.com, and pull your reports. Check them for errors. A mistake on your report could be costing you hundreds of dollars a year. Dispute any inaccuracies immediately. Second, and this is the most important thing you can do, pay every single bill on time. Even if it's just the minimum payment, make sure it's on time. Set up automatic payments for everything you can. One late payment can stay on your credit report for 7 years. Third, attack your credit card balances. Focus on paying down cards that are close to their limits. Getting your overall utilization ratio below that 30% threshold can provide a significant and relatively quick boost to your score. Fourth, don't go on a closing spree with old accounts. If you have an old credit card with no annual fee that you rarely use, just put it in a drawer. Keeping it open helps maintain the average age of your credit history, which is a positive factor. And finally, be strategic about applying for new credit. If you know your car insurance renewal is coming up in a few months, it's probably not the best time to apply for 3 new retail store cards just to get a 10% discount. Space out your applications and only apply for credit you actually need. By taking these steps, you are not just improving your financial health, you are actively lowering your perceived risk in the eyes of your insurer. You are rewriting the story your data tells about you. You're turning yourself from a statistical liability into a statistical asset. But here's the frustrating part. You can do all of this. You can have a spotless driving record for a decade. You can cultivate a perfect insurance score. You can be the model customer in every conceivable way. And your premium can still skyrocket for a reason that has absolutely nothing to do with you. It's a reason determined by a map, a line drawn by an analyst in an office hundreds of miles away, that can cost you thousands. It's based on the simple, and sometimes infuriating, fact of where you park your car at night. In the next part, we're going to expose the invisible but expensive world of territorial ratings, and explain why just moving a few blocks can change your insurance bill more than anything else you do. It's one of the most maddening mysteries of car insurance. You get your renewal and the price has jumped. You haven't had an accident. You haven't gotten a ticket. Your car is a year older and worth less. So what gives? The answer is often hidden in a term the industry uses called territorial ratings. And it's a system that works like an invisible grid laid over every town and city in America, sorting us into boxes of high and low risk. Imagine an invisible wall running right down the middle of a major avenue in your city. On one side is zip code 90210, and on the other is 90211. To you, it's the same neighborhood, the same coffee shops, the same grocery store. But to your insurance company, it's a night and day difference. A driver living on the west side of that street might pay 20, 30, even 50% more for the exact same coverage as a driver living on the east side. Same car, same driving record, same person. The only difference is which side of that invisible line they park on at night. This isn't an exaggeration. It's the daily reality of territorial ratings. Insurance companies are masters of data. They collect and analyze mountains of information to predict the future. And one of the most powerful predictors of whether you will file a claim is, quite simply, your address. They take vast geographic areas like states and break them down, first into counties, then into cities, then into zip codes. And some of the biggest insurers break it down even further, into their own proprietary subterritories that can be just a few square blocks. For each tiny territory, they analyze a specific set of risks. The first and most obvious is crime, specifically auto theft. They have precise data from police reports and their own claims history showing exactly how many cars of which type are stolen from a given area. If you live in a zip code with a statistically higher rate of car thefts, Your premium for comprehensive coverage, which is what pays for a stolen car, is going to be higher. It doesn't matter if you have a locked garage and a guard dog. You are being rated based on the collective risk of your entire territory. Next, they look at accident frequency. Is your neighborhood full of quiet, wide residential streets and four-way stops? Or is it a dense urban core, packed with chaotic intersections, relentless traffic, and a constant struggle for street parking? The data tells them exactly how many accidents, from minor fender benders to major collisions, occur per square mile in your territory. More traffic density, more complex intersections, and more parked cars lining the streets all translate to a higher probability of a claim. So, even if you're the safest driver in the world, if you live and park in a high-traffic, high-accident zone, you will pay more. You're paying for the risk created by the environment around you. But it gets even more granular than that. They look at weather patterns. Is your territory in a hail alley, where cars are frequently damaged by severe storms? That increases the risk of comprehensive claims. They even look at the quality of road maintenance in your area, because more potholes can lead to more tire, wheel, and suspension claims. And then there's the factor that almost no one outside the industry knows about: the local legal climate. Insurers call it social inflation. In certain counties or judicial districts, juries are known to award much larger settlements for injuries in car accident lawsuits. A whiplash claim that might settle for $50,000 in one county could result in a jury verdict of $500,000 just one county over. Insurance companies track this data obsessively. If you live in a territory that they consider litigious, where people are more likely to sue and juries are more likely to be generous, your liability premiums will be significantly higher. You are paying extra to cover the potential for a massive lawsuit, simply because of the legal reputation of the courthouse in your district. Let's make this real. Meet two friends, Sarah and Jessica. They're both 30 years old. They both drive identical 2022 Honda Civics. They both have perfect driving records. No tickets, no accidents. They even work at the same company. The only significant difference is where they live. Sarah rents an apartment in the heart of downtown. Jessica bought a small house in a quiet suburb just 8 miles away. When they compare their insurance renewal notices, they're stunned. Jessica's 6-month premium is $450. Sarah's is $800, nearly double. Sarah's furious. She calls her agent, demanding an explanation. The agent pulls up her policy and explains, "Sarah, it's your territory rating." He points out that her downtown zip code has a vehicle theft rate that's 4 times higher than Jessica's suburb. The number of collision claims per 1,000 vehicles is almost triple. And to top it off, their city's downtown core is in a county known for multi-million-dollar lawsuit verdicts. Sarah hasn't done anything wrong. She's a great driver. But she is paying a penalty for the statistical risk of her environment. She's paying for the cars stolen from her neighbors, for the fender benders happening at the busy intersection on her corner, and for the lawsuit-friendly reputation of her local court system. Jessica, just a few miles away, is getting a massive discount for the relative peace and quiet of her suburban streets. This is critical to understand when your renewal comes up. You might see a rate increase and assume it's something you did, but you could be the victim of a territory re-rating. Perhaps there was a recent spike in catalytic converter thefts in your neighborhood, or a few very expensive high-profile accidents. The insurance company's data analysts will flag your territory, revise its risk profile upwards, and at the next renewal cycle, everyone in that territory sees their rates climb. You haven't changed, but the risk profile of the ground beneath your car has. This is also why it is absolutely essential to get an insurance quote before you move. People spend months searching for the perfect apartment or house, but they only think about insurance after they've signed the lease or the mortgage. They might find they've unknowingly moved from a low-risk, affordable territory to a high-risk, expensive one, adding $100 or more to their monthly budget unexpectedly. A quick call to your agent with a potential new address can save you from a massive financial shock down the road. Ultimately, the logic of territorial rating feels both perfectly rational and deeply unfair. From the insurer's perspective, it's just math. They have a century of data that proves, beyond any doubt, that location is a powerful predictor of future claims. They aren't judging you. They are pricing the statistical risk of your parking spot. But from your perspective, you're being penalized for factors completely outside your control. You're being judged not by the content of your driving record, but by the zip code of your residence. It's a system that can create bizarre and frustrating outcomes, where a move of 1,000 feet can impact your wallet more than 1,000 miles of safe driving. So you've got the perfect driving record and you live in the right neighborhood. But what if the biggest trap in your renewal isn't what you've done, or where you live, but what you've chosen? In the next part, we're going to decode the cryptic language of your policy, comprehensive, collision, liability, and reveal how a simple choice you made years ago could be costing you a fortune today. That choice, for millions of Americans, happens the very first time they buy car insurance. You're young, you're just trying to get on the road, and you see a bunch of confusing terms with numbers next to them. You ask the agent, or you click the button online for the cheapest legal option. You just want the piece of paper that says you're good to go. And then you forget about it. For years. Your policy renews, the price creeps up, but the core of it, that initial uninformed choice, remains frozen in time. A financial time bomb ticking away, hidden in plain sight on your declarations page. Let's defuse it. Right now. The absolute bedrock of every single car insurance policy in the United States is liability coverage. This isn't for you. This is for the other guy. It's the coverage that pays for the damage you cause to other people and their property if an accident is your fault. Think of it as your, "I'm sorry I wrecked your car and sent you to the hospital" fund. It's broken into two key parts: bodily injury liability and property damage liability. Bodily injury, or BI, covers medical bills, lost wages, and pain and suffering for people you injure. Property damage, or PD, covers the cost of repairing or replacing whatever you hit: another car, a fence, a lamppost, a storefront. You'll usually see this written as three numbers, like 25/50/25. This is the secret code. The first number is the maximum amount, in thousands of dollars, your insurance will pay for one person's injuries. In this case, $25,000. The second number is the maximum total they'll pay for injuries for the entire accident, no matter how many people are hurt. Here, $50,000. The third number is the maximum they will pay for all property damage. In this example, $25,000. Now, here is the terrifying part. Those numbers, 25/50/25, are the state-mandated minimums in many places. They are the absolute lowest amount of coverage you can legally have to drive a car. And they are a financial catastrophe waiting to happen. Let's play this out. You have that minimum 25/50/25 policy. You're driving to work, you glance at your phone for a split second, and you rear end a brand new SUV. The driver and passenger both get whiplash and need MRIs, physical therapy, and miss a month of work. Their combined medical bills and lost wages hit $70,000. Your policy's limit for the entire accident is $50,000. That's all the insurance company will pay. Where does the other $20,000 come from? Comes from you. But wait, it gets worse. The SUV you hit? It's a new model loaded with tech. The repair bill is $32,000. Your property damage limit is only $25,000. So you're on the hook for that extra $7,000 too. In one split-second mistake, you are now personally facing a $27,000 bill. The other driver's insurance company will pay to fix their client's car, and then their lawyers will come after you to get that money back. They will garnish your wages. They will put a lien on your house. They will seize your savings. Your financial life for the next decade can be defined by that one moment where you tried to save a few bucks a month on insurance. The choice you made when you were 20 years old, just wanting the cheapest option, could bankrupt you when you're 35. This is the single biggest risk most middle-class Americans are unknowingly taking. So that's liability. That's for them. What about for you and your car? That's where collision and comprehensive coverage come in. These are often called full coverage, but they are totally separate and often optional. Collision coverage pays to repair or replace your car. If you're in an accident, that is your fault. You hit a tree, you back into a pole, because a multi-car pileup collision is what fixes your vehicle. Comprehensive coverage is sometimes called other than collision. It's for all the weird stuff that can happen to your car when you're not even driving it. A tree branch falls on it during a storm. It gets stolen. It's vandalized. You hit a deer on a country road. Hail turns your hood into a golf ball. All of that is comprehensive. Here's the key question for both. What is your car worth? If you're driving a 15-year-old car with 200,000 miles that's worth maybe $2,000, paying an extra $400 a year for collision coverage might not make sense. You're paying a huge percentage of the car's value every year just to protect it. But if you're driving a $40,000 car, going without collision and comprehensive is a massive gamble. One bad slide on some ice and your $40,000 asset is gone, and you're still making payments on it. The choice you made about these coverages on your last car might be completely wrong for the car you drive today, but many people never think to change it at renewal. But there's one more piece of this puzzle, and it's perhaps the most overlooked and tragically necessary coverage of all: uninsured or underinsured motorist coverage, also known as UM/UIM. Remember our liability discussion? That was about you having enough insurance to pay for the damage you cause. Well, what happens if someone else hits you, and they don't have insurance? Or they have those pathetic state minimums that don't even begin to cover your new car and your medical bills? Statistics from the Insurance Research Council show that about 1 in 8 drivers in the United States is uninsured. That's more than 12% of people on the road with you right now who have zero ability to pay for the damage they cause. In some states, it's as high as 1 in 4. This is where UM/UIM becomes your financial life raft. It steps in and acts like the other driver's insurance. Your uninsured motorist bodily injury coverage pays for your medical bills when an uninsured driver hurts you. Your underinsured motorist coverage kicks in when the at-fault driver has insurance, but their liability limits are too low to cover your expenses. It bridges the gap. Some states even offer uninsured motorist property damage, which is a lifesaver for fixing your car without having to pay your own collision deductible when a ghost driver hits you and runs. Let me be perfectly clear. Liability coverage protects your assets from people you might hurt. Uninsured motorist coverage protects your health and your family from the massive, and frighteningly common, risk of being hurt by someone who made the irresponsible choice to drive without adequate insurance. It is you insuring yourself against everyone else. So take a look at your policy, that piece of paper you get every 6 or 12 months. Don't just look at the price. Look at the numbers. Are you carrying the state minimum 25/50/25? You are playing a game of financial Russian roulette every time you get behind the wheel. Most financial advisors and insurance experts would tell you that a policy starting at 100/300/100 is a much safer foundation for protecting your future. The difference in price is often far less than you think, but the difference in protection is life-altering. Do you have collision and comprehensive on a car that's barely worth $1,000? Or did you drop them on a car that's still worth 20 grand? And most importantly, do you have uninsured motorist coverage to protect you from the 1 in 8 drivers who can't pay for the damage they will cause? These are the choices, the levers inside your policy, that have a monumental impact on your premium and your protection. But there's another critical choice we haven't talked about. It's a single number that you choose for your collision and comprehensive coverages. It dictates how much you pay out of pocket for any claim, and it can swing your premium by hundreds of dollars a year. It's your deductible, and choosing the wrong one isn't just about money. It's about understanding your own behavior and when you're most likely to actually use your insurance. Think of your deductible as the cover charge to get into the My Insurance Company Will Now Pay Club. You have to pay it first every single time you want to use your collision or comprehensive coverage. It's the amount of risk you agree to absorb yourself before the insurer steps in. And the relationship is a simple, powerful seesaw. The more risk you take on, meaning the higher your deductible, the lower your monthly premium will be. The less risk you take on, a lower deductible, the higher your premium. Sounds simple, but this is where millions of drivers make a critical financial mistake, born from a psychological trap we all fall into: optimism bias. When you're buying or renewing your policy, you're not thinking about a crash. You're thinking about your monthly budget. An agent or a website shows you 2 options. Option A has a $500 deductible and costs $150 a month. Option B has a $1,000 deductible and costs only $120 a month. You do the quick math. $30 a month. That's $360 a year. You think, I'm a great driver. I haven't had an accident in years. Why would I throw away $360? So you take the higher deductible, pocket the savings, and feel like you've just outsmarted the system. And for a while you have. Month after month, you're saving money. But then one rainy Tuesday, you're pulling out of a parking spot. You misjudge the distance to a concrete pillar. It's a low-speed crunch, but it's ugly. The bumper is cracked. The quarter panel is dented. You take it to a body shop and get the estimate $2,800. You call your insurance company to file a claim. The adjuster is friendly, efficient, and approves the repair. And then they say the words, "Okay, so you'll just be responsible for your $1,000 deductible. Pay that directly to the shop, and we'll cover the remaining $1,800. In that moment, the $360 you saved over the last year feels like a joke. You now have to come up with $1,000 in cash right now just to make your car drivable again. It would have taken you almost 3 years of those $30 a month savings just to break even on this one single deductible payment. This is the deductible trap. We choose it based on the best case scenario, never having an accident, but we have to live with it in the worst case scenario. So why do deductibles even exist? It's not just about sharing the cost. It's also about efficiency. Insurance companies call it a nuisance claim filter. Imagine if you had a $0 deductible. You'd file a claim for everything. A tiny door ding from a shopping cart? Claim. A small scratch from a tree branch? Claim. A cracked taillight? Claim. The administrative cost for the insurance company to process thousands upon thousands of these tiny $100 claims would be astronomical. To cover those costs, they'd have to jack up everybody's premiums. The deductible forces you to handle the small stuff yourself. It makes you ask the critical question: is this damage really worth paying $500 out of my own pocket, plus having a claim on my record that could raise my rates later? For a small scratch, the answer is no. You just saved the entire system, including yourself, a lot of money. The deductible ensures that insurance is used for its intended purpose, protecting you from significant financial losses, not minor cosmetic inconveniences. So how do you choose the right number and avoid the trap? It comes down to one simple, non-negotiable rule. Your deductible should never, ever be higher than what you have saved in a liquid, easily accessible emergency fund. Read that again. Do not set a deductible based on what you hope you can pay. Set it based on what you know you can pay tomorrow without breaking a sweat. If you have a $1,000 deductible but only $300 in your savings account, you haven't bought a policy. You've bought a ticket to a financial crisis. When that accident happens, you'll be forced to put that $1,000 on a high-interest credit card, completely wiping out years of premium savings in a matter of months. The best way to think about this is to ask yourself, what's the largest check I could write for a car repair today without it derailing my finances or causing me to lose sleep? For some people, that number is $250. For others, who are disciplined savers with a robust emergency fund, that number might be $2,500. If you can comfortably handle a larger, one-time expense, then you can leverage that financial stability to your advantage. By choosing a higher deductible, say $1,000 or $1,500, you can reap significant, long-term savings on your premiums. You are essentially telling the insurance company, I'll self-insure for the medium-sized problems, you just cover me for the catastrophes. This is the financially savvy way to use a high deductible. It's a calculated risk, backed by a solid financial safety net. But it gets more nuanced than that. You don't just have one deductible. You typically have two major ones, one for collision and one for comprehensive. Collision covers damage to your car from, well, a collision hitting another car, a pole, a wall. Comprehensive covers almost everything else: theft, vandalism, fire, flood, hail, or hitting an animal. And here's a pro tip most people miss. These two deductibles do not have to be the same amount. This is where you can get strategic. Analyze your specific risks. Do you live in an apartment complex with a crowded, tight parking lot where fender benders are common? You might want a lower collision deductible. But maybe you live in a region with very few car thefts and you always park in a secure garage. You could probably afford a higher comprehensive deductible. Or let's flip it. Maybe you're a hyper-cautious driver with a perfect record, but you live in the middle of deer country, or in a city known for hailstorms and smash-and-grab break-ins. In that case, you might opt for a very low comprehensive deductible like $250 or even zero, while keeping your collision deductible higher at $1,000. You are tailoring your policy to your life. You're not just picking a number off a menu. You're actively managing your unique risk profile. And there's one more critical piece of the puzzle. There is one part of your policy that has no deductible at all: your liability coverage. This is the single most important coverage you have, because it pays for the damage you do to other people and their property. If you cause an accident that totals someone else's $60,000 SUV and sends them to the hospital, your liability insurance pays for their car and their medical bills from the very first dollar, all the way up to your policy limit. There is no $1,000 deductible you have to pay first. This is because the system is designed to make sure the victims of an accident you cause are made whole, without having to wait for you to scrape together a deductible. Your financial responsibility is to pay your premium. The company's responsibility is to protect the public from the financial damage you might cause. So, as your renewal date approaches, don't just let that deductible number roll over. Your life has changed in the last year. Maybe you've built up your emergency fund and can now confidently raise your deductible from $500 to $1,000, saving yourself a few $100 a year. Or maybe you just had a baby, your budget is tighter, and the thought of a surprise $1,000 bill is terrifying. Now is the time to lower that deductible for greater peace of mind, even if it costs a bit more each month. The deductible is not a static number. It's a dynamic reflection of your current financial health. Choosing it wisely is about striking a balance between monthly savings and your ability to handle a sudden financial shock. It's a decision that defines the very moment insurance transforms from an abstract bill into a tangible, real-world lifeline. You've decided what you are willing to pay out of pocket. But that brings up an even bigger question. Once you pay your part, what is the absolute maximum the insurance company is willing to pay? Because that number isn't infinite. And if you get it wrong, it could be the costliest mistake of your life. That number is your coverage limit. And these limits are not just a single number. They're a secret code written on your policy declarations page. It usually looks like 3 numbers separated by slashes, something like 25/50/25, or 100/300/100. Most people see these numbers, their eyes glaze over, and they just look at the final price. This is a catastrophic mistake. Because understanding this 3-number code is the difference between a car accident being an inconvenience and a car accident ending your financial life. Let's break the code. It's simpler than you think, and it's arguably the most important financial knowledge you can have as a driver. The first number is the bodily injury liability limit per person. This is the maximum amount your insurance will pay for a single person's medical bills, lost wages, and pain and suffering if you cause an accident. The second number is the bodily injury liability limit per accident. This is the total maximum your insurance will pay for all injuries combined in a single accident you cause, no matter how many people are hurt. The third number is the property damage liability limit. This is the maximum your insurance will pay to repair or replace the other person's property. That usually means their car, but it could also be a storefront, a guardrail, or a very expensive custom mailbox. Now let's see why this matters. Let's invent a driver. We'll call him David. David is a good guy, a safe driver. He lives in a state where the legally required minimum coverage is 25/50/25. He thinks, I'm a safe driver, and this is what the law requires. I'm covered. He gets his renewal notice, sees he has 25/50/25, and pays the bill. He's done his duty, or so he thinks. One rainy Tuesday, David is driving home from work. He's a little distracted, glances at his phone for just a second, and when he looks up, traffic has stopped. He slams on the brakes, but it's too late. He rear-ends the car in front of him. It's not a high-speed crash, but it's a solid hit. The car he hit is a brand new Tesla Model Y. Inside are a husband and wife. The police come, reports are filed, and everyone seems okay, just a little shaken up. David calls his insurance company, feeling relieved he has coverage. A few weeks later, the calls begin. First, the estimate for the Tesla. With its specialized aluminum parts, sensors, and battery components, the repair cost isn't $5,000 or $10,000. The repair bill is $62,000. David hears this and thinks, wow, that's a lot. Good thing I have insurance. But then the insurance adjuster calls with the bad news. David's property damage limit, that third number in the code, is $25,000. His insurance company will write a check for $25,000 and that's it. They have fulfilled their legal obligation. The other driver's insurance company isn't just going to eat the rest of the cost. They turn to David. He is now personally, legally on the hook for the remaining $37,000. $37,000. That's a new car. That's a down payment on a house. And it's now his personal debt. But the nightmare is just beginning. The couple in the Tesla, who seemed okay at the scene, started having neck and back pain the next day. A classic case of whiplash. They go to the hospital, they see specialists, they need months of physical therapy. The driver's medical bills total $35,000. David thinks back to his coverage. Okay, 25/50/25. The first number is 25. That's for one person. His insurance company pays out $25,000 towards the driver's medical bills. David is now personally on the hook for the other $10,000. His personal debt is now up to $47,000. Then come the bills for the passenger. Her injuries were less severe, but her medical costs still come to $20,000. David breathes a tiny sigh of relief. His per-person limit is $25,000, so he's covered for her, right? Wrong. This is where the second number comes in, the cruelest twist of all. His bodily injury limit per accident is $50,000. The insurance has already paid $25,000 for the driver. That means there's only $25,000 left in the pot for this entire accident. Even though the passenger's bills are only $20,000, which is under the per-person limit, the total for the accident is now $55,000, $35,000 plus $20,000. The policy maxes out at $50,000. So David is on the hook for the remaining $5,000. Let's tally up the final score. The Tesla repairs. David owes $37,000 out of pocket. The driver's medical bills. David owes $10,000 out of pocket. The passenger's medical bills. David owes $5,000 out of pocket. Total personal debt from one moment of distraction, $52,000. The other driver's insurance company sues him. They will win easily. His wages will be garnished. Liens will be put on his property. His financial future, his ability to save for retirement to help his kids with college is crippled. All because he thought the state minimum meant he was safe. The state minimum is a trap. It is a legal fiction designed to give the illusion of responsibility. These minimums were often set decades ago, when a new car cost $5,000 and a trip to the emergency room cost a few hundred. In today's world, with the average new car costing nearly $50,000 and a single minor surgery costing six figures, state minimum coverage is the equivalent of bringing a squirt gun to a forest fire. It's legally compliant, but functionally useless in a serious situation. This is why your renewal is so critical. It is your annual opportunity to escape this trap. When you get that document, you need to ignore the premium for a moment and find those three numbers. So what should they be? While it depends on your personal financial situation, a good, responsible starting point for many Americans is 100/300/100. Let's run David's accident again with this coverage. Property damage. The Tesla costs $62,000 to fix. David's limit is $100,000. Insurance pays the entire bill. David paye zéro. Bodily injury. The driver's bills are $35,000. David's per-person limit is $100,000. Insurance pays the entire bill. David pays zero. The passenger's bills are $20,000. The total medical cost is $55,000. David's per-accident limit is $300,000. Insurance pays the entire bill. David paye zéro. In this scenario, the accident is still stressful, but it's an insurance problem, not a life-destroying financial catastrophe. He pays his deductible for his own car, and his life goes on. And here is the most shocking part. The difference in premium between the disastrous 25/50/25 policy and the responsible 100/300/100 policy is often not hundreds of dollars a month. It can be as little as $10, $20, or $30 a month. For the price of a few fancy coffees, you are buying hundreds of thousands of dollars of protection. It is, without a doubt, the single greatest return on investment in the entire world of personal finance. If you own a home or have significant savings, you should consider even higher limits like $250/500/250, because you have more to lose in a lawsuit. In fact, these higher limits are often a prerequisite for the ultimate shield of protection, an umbrella policy. So when that renewal comes, don't just renew. Review. Find those three numbers that represent your liability shield. Think about the cars on the road around you. Think about the cost of an ambulance ride and a hospital stay. And ask yourself if your shield is strong enough. Because the state minimum is a paper shield, and in the real world it will tear the second you actually need it. We've just spent all this time talking about the absolute necessity of protecting yourself from financial ruin when you hurt someone else or damage their property. But this entire conversation, all these numbers do absolutely nothing for you and your car. If you have a 100/300/100 policy and you cause an accident, your insurance will pay up to $100,000 to fix the other person's car. But the amount it will pay to fix your car? Zero. Not a penny. For that, you need two entirely different kinds of coverage. And understanding how they work together is the key to making sure you ever get your own car back on the road. These two coverages are collision and comprehensive, and they almost always come as a pair. Think of them as the dynamic duo responsible for fixing or replacing your own vehicle. Let's start with collision. The name is pretty straightforward. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object. Now listen closely to that wording. Another object. Most people think this just means another car. And it does. If you rear-end someone, your liability coverage pays for their car, and your collision coverage pays for yours. But it's so much more than that. Let's say you're driving on a quiet suburban street, you look down for a split second to change the radio station, and when you look up, you swerve to avoid a squirrel and hit a mailbox. That mailbox just became another object. Your collision coverage is what pays to fix your crumpled fender. Or imagine it's winter, you hit a patch of black ice, lose control, and slide into a guardrail. The guardrail is the object. Collision coverage to the rescue. What if you're backing out of a tight parking spot, and you accidentally scrape your door against one of those concrete pillars in a parking garage? The pillar is the object. Collision coverage pays for that. It even covers you if your car flips over in an accident. In the simplest terms, if you are driving your car and it makes impact with something that causes damage, collision is what you need. But what about all the other ways a car can be destroyed? What about the things that happen when you're not even in the car? This is where its partner, comprehensive coverage, steps in. Comprehensive is sometimes called other than collision coverage, which is actually a perfect description. It covers damage to your car from a whole list of chaotic, unpredictable events that are not a collision. For example, a hailstorm rolls through and your car now looks like a golf ball. That's a comprehensive claim. A branch from your neighbor's old oak tree snaps off in a windstorm and crushes your roof. Comprehensive. You're parked downtown and someone keys your car from bumper to bumper. Vandalism? Covered by comprehensive. And what about theft? If someone steals your entire car, comprehensive coverage is what will pay you the value of your vehicle, so you can buy a new one. It also covers things like fire, floods, riots, and one of the most common claims in many parts of the country, hitting an animal. Yes, you heard that right. If a deer jumps out in front of you on a country road and you hit it, that is not considered a collision in the insurance world. It's a comprehensive claim. This is a point of massive confusion for people. The logic, as strange as it sounds, is that you didn't collide with a stationary object. A living creature collided with you. So hitting a deer? Comprehensive. Swerving to miss the deer and hitting a tree instead? That's collision. It's a bizarre but critical distinction. Together, collision and comprehensive cover almost any physical damage that could possibly happen to your car. That's why they are often sold as a package, and people sometimes just refer to it as full coverage, even though that's not an official insurance term. Now, here is the single most important thing to understand about both of these coverages. The deductible. A deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company starts paying. You choose this amount when you buy your policy. Common deductible amounts are $500, $1,000, or even $2,000. Let's make this crystal clear with an example. Say you have a $1,000 deductible for your collision coverage. You get into that fender bender and the repair shop says the damage is $4,000. You are responsible for paying the first $1,000 directly to the body shop. Your insurance company will then pay the remaining $3,000. If the damage was only $800, you would pay the entire amount yourself. Your insurance wouldn't pay a dime, because the cost of the repair is less than your deductible. This is a fundamental trade-off. A higher deductible, say $2,000, means you are taking on more financial risk yourself. Because of that, the insurance company will give you a lower premium. Your 6-month bill will be cheaper. A lower deductible, like $500, means you have less to pay out of pocket if something happens, but because the insurance company is taking on more of the risk, they will charge you a higher premium. This is one of the most critical decisions you make at every renewal. You have to ask yourself a very honest question. If I got into an accident tomorrow, could I comfortably write a check for my deductible amount? If your deductible is $1,000 but you don't have $1,000 in your emergency fund, you've set yourself up for a financial crisis. Choosing the right deductible is a personal balancing act between what you can afford to pay every 6 months for your premium and what you could afford to pay in a single unexpected moment of crisis. This brings us to the ultimate question about these coverages. Do you even need them? For liability coverage, the answer is always yes. It's required by law. But for collision and comprehensive, the answer is, it depends. It depends on 2 things: whether you have a loan on your car and how much your car is actually worth. First, the loan. If you are leasing your car or you have an auto loan you are still paying off, the answer is simple. You are required to have both collision and comprehensive coverage. No exceptions. Your lender, the bank or credit union that gave you the loan, is a part owner of your vehicle until you pay it off. They have a financial interest in that car. If you wreck it and don't have the coverage to fix it, you might just stop making payments. The bank would be left with a worthless piece of metal and a loan you're not paying. To protect their investment, they legally require you, in the terms of your loan agreement, to maintain full coverage for the entire life of the loan. They will even specify the maximum deductible you're allowed to have, usually $1,000 or less. If you try to remove this coverage, the bank will find out and they will take action, which could even include repossessing the vehicle. But what if you own your car outright? No loan, no lease. The title is in your name, free and clear. Now the decision is entirely yours. And it boils down to simple math. Insurance is designed to protect you from a financial loss you couldn't easily handle yourself. So you have to figure out how much of a financial loss your car represents. The key here is something called actual cash value, or ACV. This is what your car was worth the second before the accident happened. It's not what you paid for it. It's not what it would cost to buy a brand new one. It's the market value of your specific car, with its specific age, mileage, and condition. Let's say you have a 12-year-old sedan that you own outright. It runs great, but its actual cash value is only about $3,000. You're paying $600 a year for collision and comprehensive coverage, and you have a $1,000 deductible. Think about the worst-case scenario: you total the car. The insurance company would write you a check for its value, which is $3,000, minus your $1,000 deductible. So you would receive a check for $2,000. But you're paying $600 a year for that protection. Is it worth paying that much every year for a maximum payout of $2,000? For many people, the answer is no. At some point, the cost of the coverage starts to outweigh the potential benefit. A good rule of thumb is this: if the annual cost for your collision and comprehensive coverage is more than 10% of your vehicle's actual cash value, you should seriously consider dropping it. As long as you have enough money saved to buy another car if you need to. So when your renewal comes up, look at your policy. Find the price for collision. Find the price for comprehensive. Add them together to get your annual cost. Then go online and get a quick estimate of your car's value. Do the math. For an older, paid-off car, this is one of the easiest ways to save a significant amount of money on your car insurance. You are essentially choosing to self-insure. You're accepting the risk of replacing your own car, and in exchange, you're pocketing the savings year after year. Now you understand the coverages that pay for the other person's car, and the coverages that pay for your car. You might be thinking, great, I'm fully protected. But I have to tell you, there are still two massive, financially devastating holes in your policy. These are the situations that don't involve damaged property, but damaged people. What happens when you get hurt? Or when the person who hits you has no insurance at all? The coverages we've discussed so far won't help you with that. And the policies that do are some of the most misunderstood and most important parts of your entire insurance contract. These are the coverages that act as a safety net for your safety net. They are your personal financial bodyguards when the system fails. Let's start with the most terrifying and surprisingly common scenario. You're sitting at a red light, minding your own business, when you get rear-ended hard. The other driver is clearly at fault, but when you exchange information, they look you in the eye and say, "I don't have insurance." In that moment, your heart sinks, because everything we've talked about so far, their bodily injury liability, their property damage liability, it's all worthless. It's like having a check from an empty bank account. This is where your own policy has to step in to save you. And the first hero of this story is called Uninsured Motorist Bodily Injury Coverage, or UMBI. Think of it like this. UMBI forces your own insurance company to act as if it were the insurance company for the person who hit you. It steps into the shoes of the uninsured driver and pays for your injuries, your passengers' injuries, your medical bills, your pain and suffering, and your lost wages, up to the limits you selected. If you have $100,000 in UMBI coverage, your own company will pay for your medical costs up to that $100,000 limit, all because some irresponsible person failed to buy the insurance they were legally required to have. It's a truly bizarre concept when you first hear it. You are paying for insurance to protect yourself from people who don't pay for insurance. But in a country where it's estimated that 1 in 8 drivers is on the road illegally without coverage, it's not just a good idea, it's an absolute necessity. Now let's tweak the scenario slightly. Same accident, you're rear-ended. But this time the driver does have insurance. Relief, right? Not so fast. They have the absolute bare minimum required by the state. Let's say their bodily injury liability limit is just $25,000 per person. But the accident was serious. You have a broken arm, you need surgery, and after the ambulance, the hospital stay, and the physical therapy, your medical bills total $90,000. The other driver's insurance company will write you a check for their policy limit, $25,000, and that's it. They fulfilled their legal obligation. They will wish you the best of luck with the remaining $65,000 in bills that are now your problem. You can try to sue the driver personally, but if they could only afford minimum insurance, what are the odds they have $65,000 in assets just sitting around? Close to zero. You are now what's called underinsured. The other person had insurance, but it wasn't nearly enough to cover the damage they caused. This is where the second hero of our story comes in. Underinsured motorist bodily injury coverage, or UIMBI. This coverage is brilliant. It bridges the gap between the other driver's low limit and your actual medical costs. In our example, if you had $100,000 in UIMBI coverage, the process would look like this. You'd first collect the $25,000 from the at-fault driver's policy. Then, you would turn to your own insurance company and file an underinsured motorist claim. Your policy would then step in and pay the remaining $65,000, making you whole. Covers the difference up to your limit. In most states, these two coverages are sold together as a package, uninsured/underinsured motorist bodily injury, or UM/UIM. When you see this on your renewal, this is what it's for. It protects you from the financial irresponsibility of others. And a good rule of thumb is to carry UM/UIM limits that are at least equal to your own bodily injury liability limits. After all, if you believe you need $100,000 of coverage to protect your assets if you hurt someone else, doesn't it make sense to have the same amount of protection for yourself if they hurt you? Now what about your car? If an uninsured driver totals your brand new SUV, who pays for that? If you have collision coverage, your own policy will pay for it, no problem. You'll just have to pay your deductible. But what if you don't have collision coverage on an older car? Or what if you just don't want to pay your $1,000 deductible when the accident wasn't your fault? For that, there's uninsured motorist property damage, or UMPD. This coverage specifically pays to repair or replace your car if it's damaged by a driver with no insurance. It often has a much lower deductible than standard collision, say $250 instead of $1,000. And in some states, it can even cover hit-and-run accidents. So far, all these coverages, UMBI, UIMBI, and UMPD, are designed to protect you from other drivers. But what about your own health, regardless of who is at fault? What if you accidentally back into a telephone pole and need stitches? Or what if you're in a complex multi-car pileup, and it's going to take months to determine who was at fault, but you need medical care now? This is where the final crucial pieces of the puzzle come in. Medical payments coverage, known as MedPay, and personal injury protection, or PIP. These are often called no-fault coverages, because it doesn't matter who caused the accident. If you are injured in your car, or even as a pedestrian hit by a car, they pay out immediately. Let's start with MedPay. It's the simpler of the two. MedPay is a small bucket of money, typically ranging from $1,000 to $10,000, that is specifically set aside to pay for immediate medical and funeral expenses for you and anyone in your car. Let's say you have $5,000 in MedPay. You get into a minor fender bender, and you and your passenger decide to go to the emergency room just to get checked out. The bill comes to $800 each. You simply submit those bills to your insurance company, and they pay them directly from your MedPay coverage. No deductible, no arguments about fault, no waiting. It's fast, simple, and it ensures that immediate health needs are met without hesitation. Now, for personal injury protection, or PIP, if MedPay is a first aid kit, PIP is a full-blown paramedic team. In states known as no-fault states, PIP is mandatory, and it goes far beyond just paying initial medical bills. PIP is designed to cover a wider spectrum of economic losses that result from a car accident. Not only does it cover medical and rehabilitation expenses, but it can also cover things that MedPay won't, like lost wages if the injury keeps you out of work. It can even cover replacement services, like paying for someone to clean your house or take care of your kids if you're laid up in bed. Imagine you break your leg in a car accident and you can't do your construction job for 3 months. Your health insurance might cover the surgery, but it's not going to pay your mortgage. PIP can. It helps replace a percentage of your lost income, so your life doesn't fall apart financially while you recover physically. The limits for PIP are generally much higher than MedPay, often starting at $10,000 and going up significantly from there. A common question people ask when their renewal comes is, why do I need MedPay or PIP if I have good health insurance? It's a great question. The answer has three parts. First, your health insurance has deductibles and copays. MedPay or PIP can be used to pay for those out-of-pocket costs, so you literally pay nothing. Second, your health insurance only covers you and your family members on the plan. It does nothing for a friend or a coworker who is riding in your car and gets hurt. MedPay and PIP cover any passenger in your vehicle. And third, and most importantly, your health insurance will never, ever pay for your lost wages or for replacement services. Only PIP does that. So when you look at your next renewal declaration page, you'll no longer see a confusing list of acronyms. You'll see a team of financial protectors. You'll see liability coverage, which protects you when you're at fault. You'll see collision and comprehensive, which protect the value of your car itself. And you'll see uninsured/underinsured motorist and MedPay or PIP, which protect your body and your bank account from the chaos of the real world. Every single one has a distinct and critical job. We've now covered every major piece of a standard auto insurance policy. You now understand what you're paying for more than 95% of drivers on the road. But understanding the parts is only half the battle. The final step is putting it all together to win the renewal game. How do you take this knowledge and use it to analyze your renewal offer, spot opportunities to save, and make sure you're not just covered but covered smartly? Because the difference between a good policy and a great one isn't just about the price, it's about having exactly the right protection, for the right price at the right time. And that's where we're going next. So let's build that great policy right now. Imagine two drivers, both with clean records, both paying about the same for their insurance. Let's call them Alex and Ben. They both get into a fender bender that's their fault. The other car is a newer model luxury SUV. The damage isn't catastrophic, but it's significant. The driver of the other car has a minor neck injury. Alex has the state minimum liability coverage. In many states, that's just $25,000 for property damage and $25,000 for bodily injury to one person. The repair bill for the luxury SUV comes in at $30,000. The medical bills for the other driver, after a hospital visit and some physical therapy, hit $35,000. Alex's insurance pays out its maximum limits. But where does the rest of the money come from? The extra $5,000 for the car and the extra $10,000 for the medical bills comes from Alex. The other driver's insurance company will sue Alex personally for that $15,000. Suddenly, a simple mistake on the road has put Alex's savings, his assets, and even his future wages at risk. Now let's look at Ben. Ben had reviewed his policy at his last renewal. He realized the state minimum was a safety net made of tissue paper. For about $20 more a month, he upgraded his liability limits to $100,000 for bodily injury per person, $300,000 per accident, and $100,000 for property damage. When Ben has his accident, his insurance company handles everything. The $30,000 repair bill is fully covered. The $35,000 medical bill is fully covered. Ben pays his deductible and his life goes on. He's stressed about the accident, sure, but he isn't facing financial ruin. That, right there, is the difference between being covered and being smartly covered. It's not about finding the absolute cheapest price. It's about finding the point where value and protection intersect. So how do you find that sweet spot for yourself? You conduct a personal insurance audit, and you do it every single renewal period. First, you reevaluate your life. The policy you bought 3 years ago might be for a person who doesn't exist anymore. Did you get a new job with a much longer commute? More miles on the road means more risk. Did you buy a home? Now you have a significant asset to protect from lawsuits. Are you married? Have you had kids? Your financial responsibilities have grown, and your insurance needs to grow with them. Even something as simple as paying off your car loan changes things. Maybe you don't need gap insurance anymore, but now that you own the car outright, you want to make sure it's protected with great coverage. Your life is not static, and your insurance policy shouldn't be either. Second, you need to deconstruct your current coverages. Pull up your declarations page, that summary of what you're actually paying for. Look past the total premium and examine the individual lines. Let's start with liability, like in our story with Alex and Ben. State minimums are a joke. They were often set decades ago and haven't kept up with the cost of modern cars and modern healthcare. A minor accident involving a new truck or an electric vehicle can easily exceed a $25,000 property damage limit. A single night in the hospital can obliterate a $25,000 bodily injury limit. The recommendation from most financial experts is to carry at least 100/300/100 in liability coverage. For homeowners, an umbrella policy on top of that is an even smarter move. The cost to increase your liability limits is often surprisingly small, but the increase in protection is massive. It is the single best investment you can make in your financial security. Next, look at your deductibles for collision and comprehensive. This is the amount you pay out of pocket before the insurance company pays a dime. A higher deductible means a lower premium. It's tempting to set it at $1,000 or even $2,000 to save money. But here's the critical question. If you had an accident tomorrow, could you write a check for that deductible amount without causing a financial crisis in your household? If the answer is no, your deductible is too high. Your deductible should match your emergency fund. Don't gamble with money you don't have just to save a few bucks a month. Now find the line for uninsured and underinsured motorist coverage, or UM/UIM. This might be the most important coverage you have. It protects you when you are hit by someone who has no insurance or not enough insurance. 1 in 8 drivers in the United States is uninsured. That's over 30 million vehicles. If one of them hits you and you're injured, who pays your medical bills? Who pays for your lost wages while you recover? Without this coverage, the answer is you. This coverage steps in and acts as the at-fault driver's insurance that they should have had. Do not, under any circumstances, waive this coverage if it's optional in your state. Finally, look at the add-ons. Rental reimbursement. If your car is your only vehicle and it's in the shop for 2 weeks after an accident, how will you get to work? To school? The $30 or $40 a month for a rental car can feel like a lifesaver. Roadside assistance. It's often cheaper through your insurer than a separate service like AAA. Gap insurance. If you have a loan on a new car, you absolutely need this. It covers the gap between what you owe on the car and what the insurance company says it's worth if it's totaled. Once you've audited your needs and decided on the smart coverage levels for your life right now, it's time to execute the plan. Start this process 30 to 45 days before your renewal date. Your goal is to get at least 3, preferably 5 different quotes. Use an online comparison tool to get a baseline. Then call an independent insurance agent. They work with multiple companies and can often find deals you can't find on your own. Finally, get a quote directly from a major carrier that you might not have considered. When you get these quotes, you must compare them apples to apples. The exact same liability limits, the exact same deductibles, the exact same add-ons. The only variable you want is the price. Now let's talk about the loyalty myth. For decades, we were taught that staying with the same company for years earned you a discount and better service. This is no longer true. Many insurers now use a practice called price optimization. They use complex data to figure out which customers are least likely to shop around, and they slowly raise their rates over time year after year. They are banking on your inertia. Your loyalty could be costing you hundreds of dollars a year. Being a free agent is your superpower in the insurance market. With your new lower quotes in hand, make one final call to your current insurance company. Tell them you're prepared to switch. Say, I've been a loyal customer for X years, and I have a quote from another reputable company for the same coverage that's $300 less. Can you match it? Sometimes they will. A magical discount will suddenly be discovered to keep your business. If they can't or won't, you have your answer. It's time to go. Switching is not complicated. The new company will handle almost all of the paperwork, including notifying your DMV and your lien holder. This entire process, from auditing your policy to making the final call, might take you 2 hours total. But those 2 hours could save you $1,000 and protect you from a $100,000 lawsuit. There is no better return on your time. So when that renewal notice arrives in your mailbox or your inbox, don't just see it as another bill. Don't just sigh and pay it. See it for what it is, an opportunity. It's your biannual government-mandated reminder to take control of a major piece of your financial life. It's your chance to stop being a passive bill payer and become an active, empowered consumer. To make sure you're not just covered but covered smartly. To protect not just your car, but your family, your assets, and your future. That piece of paper isn't a burden. It's a call to action. And now you know exactly what to do.